Let me ask you something, and I want you to actually sit with it for a second. Why aren't you wealthy yet? Because if you're here, you're not asleep. You're not completely careless. You're the kind of person who thinks about money. You've probably watched videos, read articles, tried to do the right things. You know the basics. Spend less than you earn, invest consistently. Don't do something stupid with debt. Don't chase hype. So why does it still feel like you're not getting ahead? Why does it feel like your progress is slow, fragile, or constantly interrupted? And why do you sometimes see people who seem less disciplined, less careful, building more wealth than you? Here's the part nobody likes, but it's the part that actually helps. Most money problems are not information problems, they're behavior problems. And behavior isn't controlled by logic as much as people think. It's controlled by psychology. Your brain isn't designed to build wealth. It's designed to keep you safe. That sounds reasonable, until you realize what safe means to your brain. Your brain is running on ancient instincts. It prioritizes immediate comfort over long-term payoff. It hates uncertainty. It hates being wrong. It hates standing alone. It overreacts to fear and excitement. It craves certainty, even when certainty doesn't exist. And when you apply those instincts to money, you get a predictable pattern. You do things that feel responsible, but prevent compounding. You avoid discomfort now and create bigger discomfort later. You react to noise and miss the quiet power of consistency. The worst part is that in the moment, it doesn't feel like sabotage. It feels like being careful. It feels like being smart. It feels like protecting yourself. So you keep doing it, and you don't even notice the long-term cost. That's what this video is about. Not motivation, not hype. Not think positive. This is about understanding the mental traps that quietly keep people stuck, and the simple systems that help you override those traps. Because wealthy people don't have a magical brain. They just have fewer unprotected moments where emotions get to make decisions. They build guardrails. They make it difficult to panic. They make it difficult to chase. They make it difficult to lie to themselves. And those boring guardrails are what create wealth over time. So today, we're going to do two things. First, we'll identify the psychological traps that control most people's money decisions. Not because those people are weak, because they're human. These traps live in everyone. Second, we'll talk about how to bypass them with systems, not willpower. Willpower is unreliable. Your mood is unreliable. Your discipline fluctuates with stress and sleep and life. Systems don't. Before we go further, let me ask you something. Write in the comments where you're watching from and how old you are. Not for me, for you. There's something grounding about seeing your age written in your own words before you hear what comes next. All right, let's start with the first trap. And it's the one behind most smart-sounding financial mistakes. You're not just cautious with money, you're loss-focused. Most people want to make money, but they want to avoid losing money even more. A loss feels heavier than an equal gain feels good. And that difference shapes everything. Think about it. If you unexpectedly gain money, it feels nice. You move on. But if you lose money, it sticks. You replay it. You get irritated. You feel embarrassed. You start searching for a way to undo it. That emotional weight makes your brain prioritize avoid regret over build wealth. So what happens in real life? First, you keep too much money in places that feel safe, even if they're quietly hurting you. Cash feels safe because the number doesn't go down. But the number doesn't go down is not the same as you're not losing. If inflation is higher than your interest, your purchasing power is shrinking. It's a slow leak, not a crash, which is exactly why it fools people. Your brain sees no volatility and labels it safe. But long-term, that safety can become a guarantee that you'll fall behind. Second, you sell winners too early. You make a gain and you feel relief. You tell yourself you're being disciplined. You lock it in because you don't want the uncomfortable feeling of watching it drop. But you're not managing risk, you're managing emotion. And over time, that pattern caps your upside. You interrupt compounding right when it's starting to work. Third, you hold losers too long. Because selling would mean admitting you were wrong, and your brain hates that. So instead of asking, "Is this still a good decision today?" you ask, "How do I get back to even?" That question feels logical, but it's emotional, and it creates a trap. You keep weak decisions alive, hoping they redeem you, while stronger decisions get cut early because you don't want to lose what you already gained. That's how people end up with a portfolio and a financial life that's always struggling to move forward. And there's another subtle effect of loss focus that most people don't notice. It makes your risk behavior inconsistent. When you're up, you become conservative, you protect, you get cautious. When you're down, you become a gambler. You take bigger risks to avoid locking in the loss. So you become cautious when steady discipline would help, and reckless when discipline is most needed. That inconsistency doesn't feel like bad psychology, it feels like being human. But it is exactly where wealth leaks. Calm wealth rule. Real safety isn't avoiding all risk. Real safety is taking intelligent risk with rules that prevent panic. Because no risk is a myth. If you avoid markets entirely, you don't avoid risk. You just choose a different kind of risk. The risk of never compounding, the risk of inflation, the risk of needing to work longer than you want, the risk of having no margin when life hits. Wealth requires exposure to uncertainty, but controlled exposure, not emotional exposure. The people who build wealth don't ask, "How do I avoid losing?" They ask, "Can I survive the downside without making a stupid decision?" That question changes everything. Because once you plan for volatility, once you accept that dips are normal and not personal, you stop reacting like every downturn is a crisis. You become harder to break. And when you become harder to break, you stop doing the next thing that keeps people poor. You stop letting the crowd move your money for you. That's the next trap, and it's everywhere. Your brain wants to follow the crowd, and we're going to unpack it next. Your brain wants to follow the crowd. Not because you're weak, not because you're stupid, because you're human. Long before money, long before markets, your survival depended on staying connected to the group. If everyone around you ran, you ran. If everyone looked afraid, you became afraid. Belonging kept you alive. That instinct is still in you, and in the modern world, it shows up as something that looks harmless. You want confirmation. You want to know you're not the only one doing something. You want to feel like you're making a normal decision. You want to feel socially safe. And that's exactly how people get financially trapped. Because the crowd is usually wrong at the extremes. When everyone is excited, prices are usually high. When everyone is terrified, prices are usually low. And your brain does not care about price. It cares about emotion. It cares about the feeling of, I'm with everyone, so I must be safe. That's what makes crowd behavior so dangerous. It feels like protection. Here's how it plays out in real life. You're living your life, you're busy, you're not thinking about markets every day. Then you start hearing it. Friends talking, headlines, a coworker bragging, social media clips. Everyone seems to be making money in the same place. The story doesn't even matter. The asset changes every decade. What matters is the emotional pressure. Your brain starts whispering, what if they're right and you're missing it? What if you're the only one not participating? What if you look stupid later for not buying now? That pressure grows, and at some point it becomes unbearable. So you finally act. And it feels good, not because it's a great decision, but because the discomfort stops. That's what most people are actually buying when they chase the crowd. Relief. Relief from feeling left out. Relief from uncertainty. Relief from watching other people win while you do nothing. Then something changes. Reality shows up. Prices wobble. The trend slows. The headlines flip. The same people who were bragging yesterday start sounding nervous today. Now your brain flips too. Because your brain doesn't do long term. It does right now. And now it's screaming a different message. Get out before it gets worse. Protect yourself. Don't be the last fool holding this. So you sell. And you sell at the moment when selling feels emotionally necessary, which is usually close to the worst possible time. That is how people create the most painful pattern in personal finance. They buy what feels safe when it's expensive, and they sell what feels dangerous when it's cheap. Buy high, sell low. Not because they're unintelligent, because they're emotionally normal. And if you've ever done that, or felt the urge to do that, I'm not judging you. I'm pointing at the mechanism. Because once you see the mechanism, you can build a system to protect yourself from it. Here's the uncomfortable truth. It is psychologically painful to go against the crowd. This is the part people never admit. It's not just a logic problem, it's an emotional problem. When everyone around you is getting excited and you stay calm, you feel weird. You feel like the boring person. You feel like you don't get it. You start questioning your own judgment. And when everyone around you is panicking and you stay steady, you feel exposed. You feel like you're walking into danger alone. That discomfort is real. It's physical. It's social. And it's exactly why most people never become wealthy. Because wealth often requires doing the opposite of what feels socially safe. It requires buying when optimism is low and prices are reasonable, and that usually feels like you're being an idiot. It requires holding steady when everyone is screaming, and that feels like you're being reckless. In other words, to build wealth, you often have to be willing to feel temporarily wrong in public. Most people can't tolerate that. They'd rather be wrong with everyone than right alone. So here's the calm wealth rule for crowd behavior. If you feel urgency, slow down. Urgency is the emotion the crowd uses to move you. Urgency is the lever that turns your money into someone else's profit. Because think about it. If an opportunity is truly good, why does it need you to act today? Why does it need pressure? Real value doesn't beg. Real value doesn't threaten. Real value doesn't require a countdown timer. Pressure is a signal, not a feature. So how do you protect yourself from this? You don't try to become immune to emotion. That's unrealistic. You build a rule that slows you down. Here's the simplest system that works. Never make a major money decision in the moment. No big investment, no big purchase, no dramatic sell, no "I have to act now." You wait at least 24 hours. Not because waiting makes you smarter, but because waiting gives your rational brain time to show up. In the moment, your emotional brain is loud. It speaks in urgency. It uses fear and excitement. After a day, it gets quieter. You can think. You can ask a better question. Am I doing this because it makes sense, or because everyone else is doing it? Because crowd behavior is contagious. It spreads through stories. You hear a story, "This thing is the future," or "Everyone is making money," or "This will change everything." Stories are powerful because they compress complexity into a simple narrative. Your brain loves that. But wealth doesn't come from stories. It comes from fundamentals and consistency. So here's an additional filter you can use, and it's brutally effective. When you feel the crowd pulling you, ask yourself, if this opportunity disappeared tomorrow, would I feel relief or regret? If you feel relief, it was never a good decision. It was pressure. And if you feel regret, good. Now you know what emotion you're managing. You're managing FOMO, not math. Because in a long-term financial life, you will miss opportunities. You will miss winners. That's unavoidable. The goal is not to catch everything. The goal is to avoid the decisions that can permanently damage you. And crowd decisions are exactly that. They don't just cost you money, they cost you years. They cost you confidence. They make you distrust yourself. They make you feel like money is chaos, like it's gambling, like you can't win. But you can win. You just need to stop letting the crowd choose your timing. Now, once you understand this trap, you start noticing it outside investing too. The crowd tells you what to buy, what to drive, where to live, what lifestyle you should have to look successful. And that's where the next trap shows up. Your brain values today more than tomorrow. It wants comfort now and pushes the cost into the future. That's present bias, and it quietly destroys wealth even faster than the crowd does. Let's break that down next. You value today way more than tomorrow. This is one of the most expensive parts of being human because it doesn't feel like a mistake. It feels like living your life. Psychologists call it present bias, but you don't need the label. You already know the experience. A benefit right now feels real. A benefit 10 years from now feels vague. You can feel the pleasure of spending today. You cannot feel the pleasure of being financially free in 20 years. Not in your body, not in your nervous system, not in the same way. So what does your brain choose? It chooses what it can feel. That's why people say things like, "It's only a few hundred." "I deserve this." "I work hard." "I'll save more later." "I'll make it up next month." None of those sentences sound crazy. They sound normal. That's the danger. Present bias doesn't show up as a dramatic error. It shows up as 1,000 tiny, reasonable decisions that quietly block compounding. Here's what it looks like in real life. You're thinking about buying something you don't truly need. Maybe it's a new phone, a new car, a nicer apartment, a vacation you can technically afford, but only by slowing down your future. And your brain is not comparing purchase versus investment fairly. It's comparing immediate pleasure, vivid, tangible, satisfying, versus future benefit, abstract, distant, almost fictional. So the purchase wins. Not because you're irresponsible, because the future doesn't feel real. This is why so many people stay stuck even when their income rises. Income rises. They should get ahead. But present bias turns the raise into lifestyle, and lifestyle is sticky. Once you upgrade your life, going backward feels painful, even if it would make your future dramatically better. So the new normal becomes better car to higher payment, better house to higher fixed costs, more convenience to more monthly leaks. And suddenly, your future is being funded by small payments that never end. That's what present bias does. It turns long-term freedom into a series of short-term comforts. Now, I want you to see how brutal the trade actually is, because your brain will never show you the true trade unless you force it. Let me give you a simple example. Imagine you're about to spend $1,000 on something you don't need. It feels small. You tell yourself it's not a big deal. But the real decision isn't spend $1,000 or don't. The real decision is buy this now or invest it and let it compound for decades. And when you compound, the numbers get absurd. Not because you're doing anything genius, because time is doing the work. So here's the Calm Wealth tool for present bias. Make the future real. Every time you're about to spend meaningful money on something you don't truly need, you do a simple calculation. If I invested this amount instead, what could it become in 20 years? You don't need a perfect return estimate, you need a reasonable one. Write the number down. Don't keep it in your head, because the moment you write it down, something changes. You're no longer choosing between a purchase today and a vague future. You're choosing between a purchase today and a specific number later. And now, the future becomes real enough for your brain to respect it. This is how wealthy people think differently. They don't rely on discipline alone. They change the frame. They force their brain to see the true cost of small decisions. Because present bias is not just about big purchases, it's about daily convenience. It's about spending money to avoid mild discomfort. Delivery instead of cooking, subscriptions you barely use, impulse purchases late at night, upgrades that feel good for 3 days and then disappear into normal life. Most of this spending doesn't even create lasting happiness. It creates temporary relief. And temporary relief is expensive when repeated. So here's a rule that feels simple but is extremely powerful. If you wouldn't buy it again today, cancel it today. Subscriptions, memberships, apps, any monthly charge that has quietly become normal. Those charges are present bias in a recurring form. They're your future being taxed by your past laziness. Now let's connect this to something deeper, because present bias is often powered by one emotion people don't want to admit: comparison. You see what other people have, and suddenly what you have feels insufficient. You weren't unhappy 5 minutes ago, then you saw a post, a car, a trip, a house, and your brain created a story. I'm behind. That story creates discomfort, and then you spend to fix the discomfort. not to meet your needs, to calm your ego. Which leads us directly into the next trap that wealthy people learn to manage. Your brain wants to be right, not accurate. Once you believe something, you start filtering reality to support it. That's confirmation bias. And it quietly destroys wealth because it prevents learning. Let's break that down next. Your brain doesn't want truth, it wants to be right. That's confirmation bias, and it's one of the most dangerous forces in money because it blocks learning. Here's how it works. The moment you form a belief, your brain starts acting like a lawyer. It collects evidence that supports your position and quietly dismisses evidence that threatens it. Not consciously, automatically. And that means you can be surrounded by signals that you're wrong and still feel confident. Because your brain is filtering reality. This happens in investing. It happens in spending. It happens in careers. It happens in relationships. But with money, it becomes especially expensive because the feedback loop is slow and easy to misread. Let's make it concrete. You buy an investment because you believe it's undervalued. You're excited. You've built a story in your head. You feel smart, early, ahead of the crowd. Then it starts going down. Now, what should happen logically is simple. You reassess. You ask, was I wrong? You look for disconfirming evidence. You update your view. But that's not what most people do. Most people do the opposite. They start searching for reasons why they're still right. They tell themselves, the market is wrong. This is temporary. Everyone else just doesn't understand yet. This is a buying opportunity. And then they go looking for content that supports those thoughts. They find a post, an article, a video, a confident person who agrees with them. And that agreement feels like relief. It feels like safety. Not because it's accurate, because it reduces discomfort. Because being wrong doesn't just cost money, it costs ego, it costs identity. So confirmation bias protects your ego by sacrificing your wallet. And it's subtle. It doesn't feel like a mistake, it feels like conviction. That's why people are so easily trapped by it. They confuse conviction with intelligence. But conviction, without the ability to update, is not a strength. It's rigidity. And rigidity is fragile. Now here's where it gets even more dangerous. Confirmation bias doesn't just distort what you read, it distorts what you remember. You remember your wins in detail. You forget your losses, or you minimize them, or you rewrite the story. You tell yourself, that was bad luck. That wasn't my fault. I would have been right if I had more time. So your brain preserves your self-image. And because your self-image stays intact, you don't change. And because you don't change, you repeat the same patterns. This is why people can make the same money mistakes for 20 years and still think they're pretty good with money. Their brain is protecting them from the truth. Now, wealthy people aren't wealthy because they have perfect judgment. They're wealthy because they have a different relationship with being wrong. They treat being wrong as information, not humiliation. They don't need to be right. They need to be accurate. So they build habits that force accuracy, even when it hurts. Here's the calm wealth rule. If you want to build wealth, you must become someone who can update, not someone who clings. And you can't rely on your mind to do this naturally. You need structure. So, here are 3 practical systems that neutralize confirmation bias. First, you need a written record. Because if your decisions stay in your head, your brain will rewrite them later. It will change what you meant, what you knew, what you expected. So before any meaningful financial decision, an investment, a big purchase, a career move, you write down what I believe is true, why I believe it, what would prove me wrong. That last part is the key. What would prove me wrong? Because it forces you to imagine a world where your belief doesn't hold. It forces your brain to look for disconfirming evidence. And it does something else. It makes your future self honest. Months later, you can't pretend. You can't say, "Well, I always knew," because the paper proves what you actually believed. Second, you need a deliberate opponent. Your brain naturally looks for agreement, so you must intentionally create disagreement. Before you make a big decision, ask one smart person to argue the other side. Not someone who likes you, not someone who will cheer you on. Someone who will say, "Here's why this could fail." And when they speak, don't defend yourself. Don't debate. Listen. Because if you can't tolerate being questioned, you can't build calm wealth. A fragile ego creates fragile money decisions. Third, you need a truth filter question. Every time you feel yourself becoming emotionally attached to an idea, especially an investment, ask, what evidence would change my mind? If the honest answer is nothing, you're not thinking anymore. You're worshipping your opinion. That's dangerous, because money doesn't reward loyalty to beliefs, it rewards alignment with reality. Now, once you start practicing this, you'll notice something uncomfortable. A lot of the things you feel sure about are not sure. They're stories, and your brain loves stories, which is another reason confirmation bias is so powerful. Because stories give your mind a clean explanation. A hero, a villain, a simple reason why something will happen. Reality is not that clean. Reality is messy and probabilistic, but your brain hates probabilities. It wants certainty, so it grabs onto a narrative, and then confirmation bias protects the narrative. That's how people become trapped for years, not by bad luck, but by a story they refuse to let die. Now, once you see confirmation bias, the next trap becomes obvious, because it's basically confirmation bias with a number attached. Your brain latches on to the first number it sees and treats it like it matters. That's anchoring. And it controls how you buy, how you sell, how you negotiate, and how you judge value, even when you think you're being rational. Let's go there next. Your brain latches on to the first number it sees, and then everything after that is judged relative to it. That's anchoring. And once you see it, you start noticing it everywhere. In investing, in salaries, in real estate, in shopping, in how you judge yourself. Anchoring is not logic. It's a shortcut. Your mind wants a reference point. It wants a starting number. So it grabs the first one available, and then it treats that number as meaningful, even when it's irrelevant. Here's the simplest investing version. You bought something at 50. Now it's at 30. And in your head, the conversation stops being, "Is this a good decision today?" It becomes, "I just needed to get back to 50. That number becomes your emotional home base. But the market doesn't care what you paid. Reality doesn't care what you hoped. Your entry price is not a law of physics. The only question that matters is, if I didn't own this today, would I buy it at today's price? If the answer is no, then the anchor is controlling you. And that anchor keeps you in weak positions, not because they're good, but because you're emotionally attached to a number that has nothing to do with what's true right now. Now, anchoring doesn't only trap you in investments, it also makes you overpay. This is how it works in the real world. You're shopping for something expensive, a car, a house, a renovation, anything. The first price you see becomes the anchor. If the first car you see is $40,000, then the next one at $35,000 feels like a deal. Your brain feels like it won, but maybe the fair price is $30,000. You didn't win. You just moved relative to an arbitrary starting number. People think they're negotiating value, but a lot of the time they're negotiating an anchor. Salespeople know this. Advertisers know this. The entire retail world is built on it. Was $199, now $129. Your brain doesn't evaluate whether $129 is a good price. It evaluates whether $129 is better than $199. That's anchoring. And once it's set, it's sticky. It's hard to remove. So, the calm wealth rule for anchoring is simple. Ignore the first number. Wipe it from your mind. Then, do your own assessment from scratch. What is this actually worth today? Not compared to the anchor, but compared to reality. Now, this is where anchoring links directly to the next trap. And this one might be the most expensive psychological mistake people make. Sunk costs. Because once you're anchored to what you paid, you become emotionally attached to the past. And your brain starts treating the past as if it can be recovered. It can't. Sunk cost is the feeling of, I've already put so much into this, so I have to keep going. Money, time, effort, reputation, identity. And once that feeling kicks in, people do something irrational. They throw good money after bad, just to avoid admitting the original decision was a mistake. This happens in investing. You bought something at 100, it's now at 20. You tell yourself, if I sell now, I lock in the loss. So you hold. But the loss already happened. You just haven't admitted it. Selling doesn't create the loss. Selling reveals it. The question isn't, how do I get back to 100? The question is this worth 20 today? If you wouldn't buy it today, holding it is a decision. It's a decision to keep the money tied up in something you don't even believe in, for emotional reasons. This happens in business too. Someone starts a business that isn't working. They've put in months, then years, then tens of thousands. They keep feeding it, not because the future looks good, but because quitting would mean admitting that the past was wasted. But the past is gone either way. Quitting doesn't erase what happened. It stops you from turning one mistake into a bigger mistake. This happens in careers. People stay in a job they hate because they've already invested 5 years. Or they stay in a path that isn't right because they've already trained for it. But those years are gone. The only thing that matters is what you do next. Sunk cost is the trap of treating past spending as if it gives you a reason to keep spending. It doesn't. Past costs are not an investment you can protect. They are history. So here's the calm wealth rule for sunk costs. Decide from zero. Pretend you don't own it. Pretend you haven't invested a minute. Ask, if I was starting today, would I choose this? If the answer is no, the solution is not wait and hope. The solution is to exit cleanly and redirect your money and time to something that has a future. Now, notice what anchoring and sunk costs have in common. They both trap you in the past. They both make you manage your ego instead of managing your money. They both create stickiness, holding on to things longer than you should because it hurts to admit you were wrong. And that brings us to the next psychological trap, the one that turns a normal person into a disaster: overconfidence. Overconfidence is when your brain confuses a small streak of luck for skill. It tells you you're better than you are, and it makes you take bigger risks at the worst possible time. Let's go there next. Overconfidence. This is where a normal person turns a normal mistake into a catastrophic one. Because overconfidence doesn't feel like a flaw, it feels like confidence. It feels like, I finally get it. It feels like growth. And sometimes it even gets rewarded, at first. You make a couple good decisions. You pick something that goes up. You time something correctly once. You get a small winning streak. And your brain does what it always does with small sample sizes. It confuses luck for skill. It tells you, I'm good at this. It tells you, I have a feel for the market. It tells you, other people panic, but I see the truth. And then you escalate. You put more money in. You take bigger risks. You move faster. You stop listening to caution because caution now feels like negativity. This is the moment people start losing real money. Not when they're uncertain, when they're certain. Overconfidence is dangerous because it makes you blind to downside. It makes you focus on all the reasons you'll win and ignore the ways you could lose. And your brain is very good at building a winning story. It will show you the upside case in high resolution, how great it will feel, how much money you'll make, how you'll prove people wrong. But it hides the downside case. It blurs it. It minimizes it. It tells you, that won't happen to you. That's the definition of overconfidence. You don't just believe the odds are good, you believe the odds don't apply to you. This is why so many people get destroyed after a hot streak. They didn't lose because the world is unfair. They lost because they increased their risk right before reality reminded them who's in charge. And you can see this pattern outside investing too. Someone has a few good months at work, and they assume the good months will continue forever. So they raise their lifestyle. They lock in higher fixed costs. They buy the expensive car, take the bigger mortgage, stack the monthly payments. They feel successful until life shifts. And then the bills become a trap. Overconfidence makes you build a life that requires everything to go right. That is the opposite of calm wealth. Calm wealth is building a life that still works when things don't go right. So what do you do about overconfidence? You don't try to be less confident. That's not the point. You build a habit of humility, not emotional humility, practical humility. Here's the calm wealth rule. Never trust confidence outside your competence. In other words, if you don't deeply understand something, you don't get to be confident about it. Confidence without understanding is not bravery. It's gambling. And the most dangerous gamblers are the ones who think they're investors. So here are two systems that protect you. First, force yourself to write down reasons you could be wrong. Before a big decision, write down 3 ways it could fail. Not generic ones, real ones. What assumptions might not hold? What could change? What do I not control? What would make this break? If you can't think of 3 good failure reasons, that's a red flag. It means you're not seeing the risk. You're in love with the idea. Second, shrink the size of your bet when you feel most certain. That sounds counterintuitive. That's why it works. When you feel the highest certainty, that's usually when your brain is most biased. So your position sizing should be conservative. Your behavior should be slow. The people who last for decades don't let certainty speed them up. They let uncertainty slow them down. Now, overconfidence has a cousin that's even more poisonous, because it doesn't just affect your investing, it affects your spending, it affects your happiness, and it quietly keeps people poor while they think they're living well. That cousin is envy, and envy is not about money. It's about comparison. Let's go there next. Envy. This is the most wealth-destroying emotion because it doesn't just affect one decision, it infects your entire lifestyle. Greed is obvious. Greed at least points you toward wanting more for yourself. Envy is different. Envy makes you care what other people have. And the moment you care what other people have, you stop making decisions based on your own needs and start making decisions based on comparison. That's poison for calm wealth. Because comparison is endless. There is no finish line. You can always find someone with a nicer car, a better house, a better vacation, a better watch, a better life on the internet. And the scary part is how quickly envy hijacks you. You can be content, and then you see one thing. A neighbor pulls up in a new car. A coworker mentions a raise. A friend posts photos from somewhere expensive. Someone your age buys a house you can't imagine affording, and instantly your brain writes a story. I'm behind. You weren't unhappy a minute ago. Now you feel a pressure in your chest. That pressure is not coming from your actual life. It's coming from the gap between your life and the image you just saw. And your brain hates that gap. So it tries to close it, not by improving your future, by purchasing relief. That's what status spending really is, buying relief from comparison. You buy something you didn't even want to stop feeling inferior. And that purchase feels good, briefly. Then it becomes normal. The relief fades, the payments remain, and the comparison returns. That's why envy is so brutal. It never stays satisfied. You buy the new car and someone has a nicer one. You get the promotion and someone else gets a bigger one. You take the trip and someone posts a more exotic trip. So you keep running. And the faster you run, the more exhausted and financially trapped you become. This is the hedonic treadmill. You work harder, earn more, spend more, and still don't feel ahead because you're measuring yourself against moving targets. Meanwhile, the money that could have been compounding for you, quietly building your future, is being burned to maintain the appearance of success today. And appearance is expensive. Calm wealth rule. You cannot build wealth and play status games at the same time. You have to choose. Because status games require spending. They require signaling. They require upgrades. They require keeping up. Wealth requires the opposite: restraint, patience, and a willingness to look behind for a while. That's the trade. Now, I want to be clear. This isn't about never enjoying your life. It's about choosing enjoyment intentionally instead of being manipulated by comparison. There's a huge difference between buying something because it genuinely improves your life and buying something because it improves how you feel around other people. One is your decision. The other is the crowd controlling your wallet through your ego. So how do wealthy people handle envy? They do something extremely hard and extremely simple. They define enough. They decide what they want their life to look like, independent of what other people are doing. And once they reach enough, they stop competing. Because competing is expensive, financially and mentally. Here's a practical exercise. Write down 3 sentences. My definition of success is... The lifestyle I actually want is... The things I no longer buy to impress anyone are... Those sentences sound simple. They're not. Because when you write them down, you're choosing your own values over the crowd's values. And the crowd will punish you for that. Not always directly, but subtly. People will call you boring. They'll assume you can't afford things. They'll project their own insecurity onto you. You have to be strong enough to let them think whatever they want. Because if you need external validation, you will buy it. And external validation is a subscription you pay forever. Another practical tool is simple but powerful. Reduce exposure to triggers. If social media reliably makes you feel behind, it's not entertainment, it's a financial liability. If certain friends always talk in a way that makes you spend, you need boundaries. If certain environments make you feel like you have to show up with purchases, you need to stop going there or change how you engage. This isn't weakness, this is strategy. Just like you wouldn't keep junk food in your house if you're trying to eat well, you shouldn't keep envy triggers in your daily life if you're trying to build wealth. Now, envy connects to the next trap in a very specific way. Envy makes you emotionally vulnerable. And when you're emotionally vulnerable, you become vulnerable to stories. Your brain loves stories. It wants everything to make sense. It wants a neat explanation. It wants a narrative that tells you what will happen next. And the financial world is full of people selling you stories. Because if they can get you to believe the story, they can get you to move your money. That's the next trap. You love stories, and stories make you predictable. Let's break that down. Your brain loves stories, not facts, not probabilities, stories. Because stories make the world feel understandable. They create a clean explanation, cause and effect, heroes and villains. This happened because of that. And your mind craves that. It craves coherence. The problem is that money doesn't always behave in a coherent way in the short term. Markets move for thousands of reasons, many of them temporary, many of them emotional, many of them random. Prices can rise on bad news and fall on good news. You can do everything right and still have a bad month. You can do something reckless and get rewarded for a while. Reality is messy, but your brain can't tolerate messy, so it does something dangerous. It invents a story. It watches what happened, and then it creates a narrative to explain it. And that narrative feels like understanding. You hear it every day. Stocks rose because investors are optimistic. Stocks fell because investors are worried. The market is pricing in a recession. The market is celebrating good earnings. It all sounds logical. It all sounds clean. And that's the trap. A clean explanation makes you feel like you can predict what happens next. So you start making decisions based on a story. And stories are incredibly persuasive because they bypass analysis. They go straight to emotion. A story doesn't ask you to evaluate probabilities. A story asks you to believe. And if someone can get you to believe, they can get you to move your money. That's why the financial world is full of storytellers. Some of them are intentional. Some of them are just repeating what they've heard. But the effect is the same. A confident narrative can push you into a decision faster than logic ever could. Here's how this usually plays out. You're watching something rise. People are excited. The narrative forms. This is the future. This time is different. This is a new paradigm. Old rules don't apply. It sounds intelligent. It sounds modern. It sounds like you're early. And because the story is coherent, your brain starts treating it like a fact. Then you buy. Not because you evaluated the downside properly, not because you understand the full risk, but because the story reduced uncertainty. It gave you a mental map. But the map is not the territory. And eventually, reality shows up. The trend slows. Volatility appears. Prices drop. Suddenly, the story changes. Now the narrative becomes, this is manipulation. This is temporary. This is just a shakeout. This is the last chance to buy cheap. And you can always find someone to tell you the story you want to hear, because stories are infinite. There will always be content that supports your emotions. That's why story-driven investing is so dangerous. It's self-reinforcing. Your brain wants certainty. The story gives certainty. Confirmation bias protects the story, and then you become emotionally attached. At that point, you're not investing, you're defending a belief. And defending beliefs is expensive. So wealthy people learn something that looks boring, but it's a superpower. They stop listening to stories about short-term movement. They don't need an explanation for why a chart moved today. They don't need a daily narrative. They don't need constant interpretation. They focus on what actually matters over time: fundamentals, value, and behavior. Because long-term wealth doesn't come from guessing the next headline. It comes from owning good assets, staying consistent, and avoiding emotional mistakes. Calm wealth rule. If you need a story to hold it, you shouldn't own it. Because if the only thing keeping you invested is a narrative, then the moment the narrative changes, you'll panic. And narratives always change. So how do you protect yourself from story thinking? You don't try to stop your brain from loving stories. That's impossible. You build systems that keep stories from controlling your money. Here are 3 calm rules that work. First, separate entertainment from decisions. Financial news is designed to keep you engaged, not to make you wealthy. It takes random movement and turns it into a dramatic plot, because drama keeps you watching. So treat it like entertainment, or avoid it entirely. If you consume daily financial news, you're feeding your mind a constant stream of narratives, and those narratives will always push you toward action. But action is not the goal. Consistency is. Second, replace stories with questions. When you catch yourself believing a narrative, ask, what would have to be true for this to work? What could be true that would make this fail? What am I assuming? What part of this is measurable, and what part is just language? That last one matters. Stories are usually language-heavy and measurement-light. They use words like revolution, guaranteed, inevitable, cannot lose, smart money. Those words are not analysis, they are persuasion. Third, force a long timeline. Short-term stories are loud, long-term reality is quiet. So set rules that anchor you to long-term behavior. You decide on a schedule. You rebalance rarely. You invest automatically. You do not react to daily movement. This is how you starve story thinking. You remove the oxygen, constant attention. Now, here's the key insight, and it's the turning point of the whole video. Even if you understand every trap we've covered, loss fear, crowd behavior, present bias, confirmation bias, anchoring, sunk costs, overconfidence, envy, stories, even if you understand them perfectly, you can still fall into them. Because these traps don't happen in your intellect first. They happen in your nervous system. They happen fast. They happen under stress. They happen when you're tired, busy, angry, excited, insecure. Your rational brain is slow. Your emotional brain is fast. So the solution is not try harder to be rational. The solution is build systems that force your rational brain to show up before you act. That's why wealthy people don't just think differently, they live differently. They design their environment so they're less likely to make emotional decisions. They create friction for bad decisions and make good decisions automatic. That's what we do next. I'm going to give you practical calm wealth systems, not theory, that override your psychology before it overrides you. Now, here's the part that actually changes your life, and it's where most people get it wrong. They hear all these traps and they think, okay, I understand, I'll just be more disciplined. No, understanding isn't enough. You can understand every bias we talked about and still fall into it next week. You can watch this entire video, nod your head, feel clear for 10 minutes, and then make the exact same mistake under stress. Why? Because these traps don't live in your intellect first. They live in your nervous system. They show up when you're tired, when you're anxious, when you're bored, when you're excited, when you feel behind, when you feel pressured. And in those moments, your rational brain doesn't lead, it follows. Your rational brain is slow, it's expensive, it needs energy. Your emotional brain is fast, it runs on autopilot. So if your plan is, I'll just think logically next time, you're betting on your best self always being present. That's a bad bet. Real wealth isn't built by your best self, it's built by your average self. The version of you that shows up on a stressful Tuesday after a long day when you're not feeling heroic. That's why wealthy people don't rely on willpower. They build systems. They make bad decisions harder to execute. They make good decisions automatic. They create friction for impulses and remove friction for consistency. Calm wealth is not about becoming perfect, it's about becoming protected. Protected from your own urgency, protected from the crowd, protected from your ego, protected from stories, protected from the need to be right. So let's talk about the systems. And I want you to treat these like tools, not like tips. Pick one, install it, use it for a month, then add the next one. Because the goal is not to transform overnight. The goal is to redesign your decision-making, so your future stops depending on your mood. System number 1 is the simplest, and it might be the most powerful. Never make a major financial decision in the moment. Not a big investment, not a big purchase, not a dramatic sell. Not a career change, not a once-in-a-lifetime opportunity. If something needs you to act right now, it's usually not an opportunity. It's pressure. And pressure is the tool that moves money from impatient people to patient people. So the rule is simple. You wait at least 24 hours. You sleep on it. This does something your brain desperately needs. It creates space between emotion and action. Because in the moment, your brain is loud. It speaks in urgency. Do it now! Don't miss out! Fix it immediately! Get out before it's too late! But urgency is not intelligence. It's a sensation. And a lot of expensive mistakes begin with a sensation. When you wait, the sensation fades. Not always completely, but enough. And once it fades, you can ask real questions. Do I still want this when I'm calm? Do I still believe this when I'm not excited or scared? Is this solving a real problem or soothing a feeling? Am I doing this because it's smart or because it's urgent? If you do nothing else from this video, install this rule. Because it saves you from panic selling, hype buying, emotional spending, revenge trading, and those "I can't believe I did that" decisions. System number 2 is the system that turns your life into evidence instead of excuses. Keep a decision journal. This sounds nerdy. It sounds like extra work. But it solves a major problem. Your brain rewrites history. When a decision works, you tell yourself you saw it coming. When a decision fails, you tell yourself it was bad luck. Either way, you preserve your ego, and you learn nothing. A decision journal stops that. Before any meaningful decision, you write down what I believe is true, what I'm assuming, what could prove me wrong, what outcome I expect, what I'll do if it goes against me. This forces clarity. It makes your decision real, not just a vibe. And later, weeks, months, a year, you come back and review it. Were you right? Were you wrong? Which part of your thinking was solid? Which part was fantasy? This is how you get better, not by consuming more content, by learning from your own behavior. And here's the deeper benefit. A decision journal changes how you feel in the moment. When you know you'll have to write down your reasoning, you act differently. You slow down. You stop making decisions you can't defend to your future self. It creates a kind of quiet accountability. Now, system number 3 is the one that catches the biases before they take over, especially when you're emotional. Create a checklist, not a motivational checklist, a bias checklist. Because in real life, your mistakes are not usually complicated. They're repeated. You follow the crowd. You chase a story. You act out of envy. You get anchored to a price. You refuse to exit because of sunk costs. You get overconfident after a win. So the checklist is simply a set of questions you run before you move money. It can be on your phone. It can be on paper. It can be 3 lines. But it has to be written. Because written questions force your rational brain to engage. Here's what it sounds like. Am I feeling urgency? Am I doing this because other people are doing it? Am I anchored to an old price? Am I holding because I don't want to admit I was wrong? Am I buying a story instead of value? Am I comparing myself to someone? If you catch even one of these, you pause. Not forever. Just pause. Because a pause is often the difference between a calm decision and a regretful one. Now, at this point you might be thinking, okay, this is a lot of structure. Yes, because structure is what creates calm. If you want a calm financial life, you need a structured decision process. The alternative is letting your emotional brain drive and hoping it behaves. It won't. Now, the next three systems are what make this even stronger. The habit of defaulting to no, deliberately finding someone who disagrees with you, and keeping a failure log so you can see your patterns clearly. Let's go there next. System number 4, default to no. This sounds simple, almost childish, but it's one of the cleanest ways to protect your time and your money. Because most opportunities are not great. Most deals are average. Most new ideas are distractions. Most one-time chances are pressure. Most purchases are forgotten 2 weeks later. Most investments pitched with excitement are priced with excitement. If your default is yes, you will constantly be reacting. You'll be saying yes because you don't want to miss out. Yes, because someone made it sound urgent. Yes, because you want to feel like you're making progress. Yes, because you're bored. Yes, because your ego wants to prove something. And then you look up, and your money is spread across 10 mediocre decisions instead of a few strong ones. Your attention is fractured. Your spending is higher. Your portfolio is messy. Your life is heavier. That's why the calm rule is, unless something is obviously good, it's a no. Not, I'll think about it. Not, maybe. No. And here's what happens when you do this for a few weeks. You start to feel the relief. Because you're no longer negotiating with every idea that enters your life. You're no longer making micro decisions all day. You're no longer letting other people set your agenda. You're choosing. Now, people misunderstand this. They think defaulting to no means you become closed-minded. No, it means you become selective. Selective people look slow to impulsive people. But over years, selective people win. Because wealth isn't built by doing everything. It's built by doing a few things consistently and refusing the rest. So here's a practical way to apply this system immediately. For the next 30 days, any financial decision that is not necessary gets a default no. No new subscriptions, no upgrades, no impulse investments, no just because it's on sale, no I deserve it purchases unless they were planned. You're not punishing yourself, you're training your nervous system to stop chasing relief through spending, and you're giving your future self breathing room. System number 5. Deliberately seek disagreement. Your brain naturally seeks confirmation. It wants to feel safe. It wants to feel right. So if you only talk to people who agree with you, or you only consume content that supports what you already believe, you're not getting smarter. You're getting more convinced. And being more convinced is not the same as being more accurate. This is why smart people can stay wrong for a long time. They're surrounded by agreement. They've built an echo chamber. And every time they hear support, they mistake it for proof. So the wealthy habit is uncomfortable but simple. Before a big decision, find one smart person who disagrees. Not a random person who will argue for sport, not someone who's bitter, someone thoughtful. Someone who can explain calmly and clearly why this could fail. And your job is not to win the argument. Your job is to learn what you might be missing. This is hard because your ego wants to defend. It wants to show that you're competent. But if your ego is in charge, your money will suffer. So here's the calm wealth rule. If you can't tolerate being questioned, you can't tolerate risk. Because risk requires humility. Now, you might be thinking, what if I don't have anyone like that? Then you create it. You can do this with a structured process. You can literally write a section in your decision journal called Best Argument Against My Decision. And you force yourself to write it as if you were trying to talk yourself out of it. You don't get to write weak arguments. You write the strongest case against your idea. This does two things. It exposes blind spots and it cools down emotional attachment. Because the moment you can clearly articulate how something could fail, you stop treating it like destiny and start treating it like probability. That's wealthy thinking. System number 6. Keep a failure log. This is the system almost nobody does, and it might be the most valuable one. Because your biggest enemy is not the market. Your biggest enemy is repeating your own pattern. Everyone has a pattern. Some people chase, some people freeze. Some people overspend when they feel stress. Some people overspend when they feel envy. Some people hold losers forever. Some people sell winners too quickly. Some people constantly restart strategies because they need novelty. If you don't identify your personal pattern, you'll repeat it for decades. And the scary part is you won't even see it happening because it feels like you're making individual decisions, but the pattern is there. So the failure log is simple. Every time you make a money mistake, and I mean a real one, not "I paid an extra fee," you write down what happened, what decision did I make, what was I feeling, which bias was running the show, what will I do differently next time. Over time, you see yourself clearly. And once you see yourself clearly, you can design around your weaknesses. That's the entire point. Not self-criticism, self-knowledge, because self-knowledge is what makes you hard to manipulate, including by your own impulses. Now, let me tie these systems together in a way that feels simple. The systems are not meant to make you smarter. They're meant to make you slower at the right moments. They create a pause, and a pause is where your wealth is protected. The crowd can't move you if you pause. A story can't hypnotize you if you pause. Envy can't drain you if you pause. Overconfidence can't escalate you if you pause. So if you want a single sentence to remember from this section, it's this: calm wealth is built in the pause. Now, we turn this into action, because if you close this video and do nothing, you'll feel clear for 10 minutes, and then life will pull you back into autopilot. So here's the practical plan, and we're going to make it small enough that you'll actually do it. Pick one system and install it this week. If you're impulsive, install the 24-hour rule. If you keep repeating the same mistake, start the failure log. If you get caught in stories, use the checklist. If you keep saying yes to everything, practice default no. One system, 1 week. And the moment you install one guardrail, you'll feel something most people don't feel with money. Control. Not confidence, not optimism, control. Because control comes from structure. Now, in the next part, I'm going to give you a simple 7-day plan, day by day, that makes this almost impossible to avoid. And then I'll show you how to choose the one bias that is costing you the most, so you stop trying to fix everything and start fixing what matters. Now we turn this into action, because if you close this video and do nothing, you'll feel clear for 10 minutes, and then life pulls you back into autopilot. So here's a 7-day plan that's small enough to execute, but strong enough to change your trajectory. Day 1. Install the pause. Write this rule somewhere you'll see it. I don't make major money decisions in the moment. Major means a big purchase, a big sell, a new investment, a new debt, a big lifestyle change. Anything that can affect the next 12 months of your life. For the next 24 hours, you're not allowed to act on urgency. You're allowed to think. That alone eliminates a huge percentage of expensive mistakes. Day 2. Build your checklist. Create a simple note called "Before I Move Money," then write these questions. Am I feeling urgency? Am I following the crowd? Am I trying to avoid regret? Am I anchored to an old number? Am I doing this because I already spent money on it? Am I buying a story? Am I comparing myself to someone? This is not about being perfect. It's about catching the moment you're being pulled. Day 3. Start a decision journal. Pick one decision you're likely to make soon. It can be investment-related or lifestyle or debt. Write down what I believe is true, what I'm assuming, what would prove me wrong, what I'll do if I'm wrong. Keep it short, 3 to 5 lines. The value is not in writing a novel, the value is in forcing clarity. Day 4. Make the future real. Pick one temptation you've been considering, a purchase, an upgrade, an "I deserve this" thing. Now calculate the future price tag. If I invested this amount instead, what could it become over 20 years? Write the number down. This turns abstract future into a concrete trade. And once it's concrete, your brain stops pretending the purchase is free. Day 5. Create one disagreement. Before your next meaningful decision, force contradiction. Ask one smart person, "What am I missing?" Or if you don't have that person, write the strongest argument against your own idea. Not a weak argument, the strongest. Because if you can't argue the other side, you don't understand the decision yet. Day 6. Start the failure log. Write down one past mistake, not to shame yourself, to see the pattern. What did I do? What was I feeling? Which bias was it? What guardrail would have stopped me? This is how you stop repeating the same error for the next 10 years. Day 7. Automate one calm decision. Automation is your quiet superpower. Set up one automatic transfer, one automatic investment, or one automatic debt payment. Because if you rely on motivation, you'll do it when you feel good, and skip it when you feel stressed. Automation makes your future inevitable. Now let me tie this together in one clear idea. Rich people aren't rich because they never feel fear or envy or urgency. They feel it. They just don't let it touch the steering wheel. They put systems between emotion and action. And if you do that consistently, wealth becomes less about talent and more about inevitability. Now, here's the choice. You can keep running money on autopilot, making decisions that feel normal, feel safe, feel reasonable, and staying stuck. Or you can do the uncomfortable thing. Pause, check the bias, follow the system. That discomfort, waiting, saying no, being different, is the price. You either pay that price now, on purpose, or you pay a bigger price later, in stress and regret. So pick one system and install it this week. And comment your age and city, and tell me, which bias do you catch yourself in the most? Fear, FOMO, present bias, or envy? Not for me, for you. because naming it is the first step to controlling it. Now we're going to make this practical, because none of this matters if it stays intellectual. You can understand every bias, you can recognize yourself in every example, you can even feel motivated for a moment, and still go back to autopilot. So here's the plan that actually works. Small actions, on a schedule, with friction in the right places. Here's the 7-day reset. Day 1. Install the pause. Today you write one rule and you treat it like law. I don't make major money decisions in the moment. Major means a big purchase, a big sell, a new investment idea, a new debt, or anything that changes your monthly baseline. If something feels urgent, you don't act. You pause. Because urgency is not a signal of opportunity. It's a signal that your emotions are driving. And your goal is to stop emotions from touching the steering wheel. Day 2. Build the checklist. Open your Notes app and create one list called Before I Move Money. Put these questions inside. Am I feeling urgency? Am I following the crowd? Am I trying to avoid regret? Am I anchored to an old number? Am I holding because I already invested? Am I buying a story instead of value? Am I comparing myself to someone? That's it. The power is not the words. The power is the interruption. You're breaking the spell of autopilot. Day 3. Start one decision journal entry. Pick one decision you're likely to make in the next 30 days. Investment, purchase, career, housing, debt. And write 4 lines. What I believe is true, what I'm assuming, what would prove me wrong, what I'll do if I'm wrong. Most people never write this down. That's why most people never improve. Writing makes your thinking real. Day 4. Make the future real. Choose one temptation purchase you've been considering. Not a need, a want. Now, translate it into the future. Ask, if I invested this money instead, what could it become in 20 years? You don't need perfect math. You need a number big enough to make the trade emotionally visible. Write it down, because the future only changes when it becomes real in the present. Day 5. Create disagreement. Before your next major decision, do one uncomfortable thing. Ask for a counter-argument. From a smart person, if you have one, or from yourself, if you don't. Write the strongest case against your decision. Not a weak case, not "it might not work." A real case. What could break? What assumptions fail first? What are you underestimating? This is how you protect yourself from your own confidence. Day 6. Start the failure log. Write down one past mistake. Just one. What did you do? What were you feeling? What bias was in control? What guardrail would have prevented it? This isn't about shame, it's about pattern recognition. Because if you don't identify your pattern, you'll repeat it until you're old. Day 7. Automate one calm decision. Pick one action and make it automatic. Automatic investing, automatic savings, automatic debt payment. Anything that moves you forward without requiring daily discipline. Because calm wealth is built by systems, not moods. Now, let me make this even simpler. You do not need to fix your entire psychology. You just need to identify the one bias that costs you the most. For some people, it's fear. They freeze, they hold too much cash, they avoid intelligent risk. For others, it's FOMO. They chase, they overtrade, they buy hype. For others, it's present bias. They spend for relief and call it living. For others, it's envy. They buy to keep up and call it taste. Which one is yours? Because once you know the pattern, you can choose the right guardrail. If you chase, you need the pause. If you freeze, you need automation. If you overspend, you need the future price tag. If you get hypnotized by stories, you need the checklist and the journal. That's calm wealth, customized guardrails for your specific weakness. And now we end with a choice. Not a motivational one, a practical one. You can keep letting your instincts drive your money. It will feel normal. It will feel safe. It will feel reasonable. And you will keep getting the normal result. Or you can do the uncomfortable thing. Pause, write, question, automate. That discomfort is the price. You either pay the small price now, in patience and restraint, or you pay a bigger price later, in stress and regret. So pick one system today, not 7, 1. And tell me in the comments where you're watching from, how old you are, and which bias you're fighting this month. Not for me, for you. Because once you name it, you stop pretending it's not controlling you. Keep it calm, keep it simple, and let time work. Now, let's land this. Because if you've listened this far, you already know something important. You don't need more motivation. You need a different operating system. And the reason this is hard isn't because the tools are complex. It's because the tools ask you to go against your default settings. Your default settings want comfort now. They want certainty now. They want relief now. They want approval now. Calm wealth is the opposite. Calm wealth is choosing what works later, even when it feels boring now. So let me give you the most honest summary of this entire video. Your financial future is less about what you know and more about what you do when you feel something. When you feel fear, when you feel urgency, when you feel envy, when you feel excitement, when you feel behind. Those moments are where wealth is either protected or leaked. Most people don't realize that their biggest money decisions are emotional decisions. They think they're making a rational choice, but what they're actually doing is managing a feeling. They spend to soothe stress. They buy to soothe envy. They sell to soothe fear. They chase to soothe FOMO. They hold losers to soothe pride. And if you don't build guardrails, your future becomes a series of emotional payments. So here's the choice. You can keep running money on autopilot. You can keep making decisions that feel normal, safe, reasonable. And you will keep getting the normal result. Not because you're doomed, because your habits will keep producing the same outcome. Or you can do the uncomfortable thing. Pause. Write it down. Ask the hard question. Sleep on it. Automate what matters. That's the real difference. Wealthy people don't feel better than everyone else. They just build a life where feelings don't get to make the decision. They build friction around impulses. They design their environment so it's easier to do the right thing than the wrong thing. And when you do that, something changes. Money stops feeling like chaos. Because you're not fighting the market anymore. You're not fighting other people anymore. You're fighting your own reflexes, and you finally have tools. Now I want you to do one thing right after this video. Not 5, not 10, 1. Pick the system that fits your weakness best. If you chase and regret it, install the 24-hour rule. If you freeze and delay, automate one contribution. If you overspend, use the future price tag. If you keep defending bad decisions, start the decision journal. If you keep repeating the same mistake, start the failure log. If you say yes too easily, default to no for 30 days. One system. Install it today. Because the only thing worse than making a mistake is watching yourself make it again, knowing you could have prevented it. And before you go, do the comment. Write where you're watching from and how old you are. Then answer this question. Which bias costs you the most? Fear, FOMO, present bias, envy, overconfidence, or stories? Just name it. Not for me, for you. Because once you name it, it stops being your personality and becomes a pattern you can manage. And if you want, in the next video, I'll give you something even more practical. A one-page calm wealth checklist you can keep on your phone. The exact questions to run before any purchase, any investment, any big decision. No hype, just guardrails. Keep it calm, keep it boring, and let time do the heavy lifting.